I think they're beginning to move in a direction none of us would have ever seen. Now, just to touch base on what you were talking about with John Rubino, he's one of the smartest guys in the industry, and I take very seriously the things that he says, and he's right. Look, forget about all the Doge. I mean, yes, let's just say they are able to take $1 trillion right off the top, which hopefully they will. That's what they were saying that they thought was realistically possible, not the 2 trillion they originally talked about. But look at it this way. I mean, it's just simple math at this point, right? The United States owes $28 trillion in government bonds or the payments to the government bonds that mature in 2028. In 3 years, we owe 28 trillion. Now that doesn't take into account anything else in terms of running the government. And we've already spent over 800 billion this year in debt created, and it's only February. So we're going to see another trillion or two added to the debt this year in the form of deficit spending, and then most likely we'll see that continue. But we only bring in tax revenue on a good year, maybe $4.5–5 trillion max. I don't even think we've gotten to five, but call it five. In 3 years, that's 15 trillion in tax revenue against 28 trillion owed in bonds that are coming due, let alone all the bonds that we're issuing right now and all of the other indebtedness. So yes, this is a real life problem. This is a problem that is beginning to get certainly more serious by the day. And that's why we're talking about revaluing gold, and we're seeing such overt moves by the administration on so many other levels. I think we have to see such a shock and awe type of move as well as it relates to dealing with this debt spiral. And I know the title of I saw something you sent out on LinkedIn today talking about the divergence between spot, London spot, and New York delivery. And it's pretty sizable. It was bigger. It was at one point, I think it was about $80, but right now, last I looked, the London spot future in gold was about $25 lower than it is in New York futures. And I looked at it this morning, and it was like 29.27 in London and 29.51 in New York in terms of futures prices. That's almost a $25 spread. But we're seeing the same thing with silver too, interestingly. Earlier today, the London spot price was 32.74, and the New York futures price 33.38. That's a 64-cent spread. It's becoming, I think, a little bit more obvious what's going on here, and I don't know how easy we're going to see bars continue to flow this way under the guise of tariffs. But we're not seeing bars being repatriated for tariffs. These bars are being reshored. We're restocking the coffers. I don't believe that it would be, if it's coming from London, they're not doing it to preempt the audit at Fort Knox, because they would be 400-ounce bars that would be coming from London. They would have to go by way of a refining, either to the Royal Canadian Mint, but more than likely to Switzerland, and they would come in the form of 100-ounce bars. We're also repatriating them from other parts of the Orient and all around the world. We're bringing in as much as we can. In fact, we've become net importers, as we've talked about. But really what we see, in my opinion, is we will begin to see investors or big players begin to lose confidence in the paper gold markets. Maybe we're already seeing that, where there's 3 or 4 or 5 or however many contracts issued per bar. And I think what people are realizing is that physical possession is very important right now, and this could very quickly push prices considerably higher as there is a scramble for physical, and it could put some of these banks, these clearing banks or bullion banks, to the brink of collapse or default. This is an existential threat to these banks, which in my mind would trigger a cascading event. Obviously, it would jeopardize the LBMA's ability to settle contracts, but at T+8 weeks right now, you could argue it already is a default. And this is the largest over-the-counter market in the world for gold. Most of the transactions there are settled in paper, rather than physical. But now we're beginning to see a cascade of delivery demands, which very quickly can expose the whole system and or create a run on the vaults, just like a run on the banks, and realizing that there's not enough physical gold there to cover. This has never happened before. We've talked about it on your show for 4 years, but never like this. It was that little by little thing. So is it something that is related to the Basel III Accord, which United States banks, I guess, are going to embrace in July, maybe, which allows them to, call it a tier one asset, at least in terms of their ability to borrow off it against an asset to borrow against with the Fed? I don't know. I don't think it's just that. I think it's something deeper, but whatever it is, it's beginning to really shake things up across the globe as it pertains to the physical gold market and the physical silver market. It hasn't spilled into our reality yet, but it will. And what's really interesting more than anything is the lease rates are spiking. And the lease rates are what are used for players to borrow gold or lease gold in an interim if they don't have the gold that they're supposed to get. It's delayed. There's refining delays. There's supply chain delays. So they would borrow gold or borrow it from or lease it from a bullion bank, as an example. And usually it was just 20, 30 basis points to do so that they could use it to make their jewelry or their bars or whatever they need. They have a contract, let's say a 30-day contract, to get that bar. They're paying, not much, might amount to 1% over the life of the contract, but then they get that bar that was delayed and give it back to the party they leased from. Well, these lease rates have spiked to 5, 6, 7% or higher. Same thing, you're seeing the exact same thing on SLV and GLD. The lease rates for the shares to borrow them have gone from 0.5% to 12% in 3 weeks, gone up 24-fold. And the number of shares that you can use to borrow to short the price or the stock has gone in SLV from 10 million to 10,000 in just a few weeks. That's a 99+% reduction. So there's some very interesting things going on that might really lead to a greater price discovery of what gold and silver should actually be priced at, which none of us really know. But I will tell you this, being naked short right now in London must be very frightening. And we haven't seen the end of this yet. That's maybe the beginning of a reset. That's when the whole thing resets. And the systemic nature, you look at these bullion banks. Well, these bullion banks are the biggest commercial banks in the United States. You Bank of America, Citibank, JP. Could that be the beginning of a reset? I mean, what is the dollar really, but based upon the confidence of this country? Our treasuries based upon confidence. Everything is based upon confidence, really. And that's the whole premise, I guess, of moving back towards issuing treasuries backed by gold so that they don't have to trust us any longer, but instead have the ability to stand for delivery on those treasuries at maturity in gold. So that's a big thing if institutions begin to lose trust. And you could argue that some may be beginning to lose trust right now in the Bank of England and the LBMA. And what could happen in a market that is dominated by paper settlement, and these entities at the end, the person who went long. So if a bank like Standard Chartered or Deutsche Bank goes short and keeps going short with nothing behind it, knowing that the probability, if they keep doing this, that the long will just capitulate, they say, no, we'll stand for delivery, but I don't have the gold. They say, well, that's a problem. And the systemic nature of it all, where all these banks are connected. This is why evidently UBS had to bail out Credit Suisse, or would have brought down the entire matrix. So these banks are not just bullion banks. They're highly connected systemically through all different forms of derivatives through the whole ecosystem. Is it the beginning of some sort of an event, a blow up? I doubt it, but who knows? The whole system is, I think, frail to say the least. And but that's how serious it truly is. You see a failure to deliver or by one of these big banks, and it's a daisy chain, certainly to the metals market. But what does it mean to the other areas that these banks are invested in, to the bank itself, to the tax credit default swaps, rather, to the insurance industry that backs that up? The whole thing is has been layered and layered and layered through derivatives so deep, so intertwined that it's something that we probably don't want to find out. I mean, I could find out. I don't believe the Exchange Stabilization Fund. I mean, it is opaque, and it is managed by the Department of Treasury, and it's very they don't really talk much about it. It operates very secretly, but its main goal is to stabilize the dollar relative to other currencies. I mean, I guess you could make an argument that that's if the world has lost confidence in the Treasury, the U.S. Treasury bond, that would certainly wreak havoc on the value of the dollar. And it's ironic too, because if I'm not mistaken, I'm fairly certain that it was initially funded with $2 billion in gold loaned by the Federal Reserve. And so could they? I guess they could, largely because everything I've ever read about it says that it lacks transparency. And who knows, if it's run and administered by the Treasury, yeah, absolutely. They could, I suppose, the more that I think about it. Its main objective is to maintain dollar stability. So yeah, I guess why not? You could make that argument that this is something that would be needed. It's an interesting point. Haven't thought about it, but I like it. I wouldn't put it past Trump. And quite frankly, if you think about what would happen if there was complete and total loss of confidence in the treasuries, yeah, that would not be good for the value of the U.S. dollar. So sure, I guess it could be. I don't know how I'd find out, but I can poke around and see.